So we've touched on this topic in the past, and that is this idea about how investors mistakenly track book value and market value when analyzing their performance. And that couldn't be actually more from the truth than what they would expect. So what the book value, when you look at your statement, is simply to give you a calculation of what type of potential capital gain tax you will have, because the difference between your market value and your book value is potential capital gains or realized capital losses or gains. But what's interesting is that has nothing to do with the amount of money that you invested initially. And for an example, like in the last 18 months, markets have kind of been sideways to negative. 2022 was an extremely negative year for all asset classes, except for potentially something like, say, private real estate or private debt. So take a private debt security that is paying an 8% interest distribution throughout the course of the year and provides a pretty impressive return compared to markets. However, if you look at, say you invested $100,000 into this private debt security, and at the end of the year, your market value would be $111,000, fees, not being considered. However, your book value is also $111,000. So if you looked at book value and market value to assess the potential return, it looks like you didn't make any money. And this is all too common for investors where they're analyzing, they're looking at statements, and they're looking at the tax calculation rather than trying to calculate or find on their statements or receive the proper reporting from their advisor that shows time-weighted returns that show the exact performance, which is money in and the amount of money that you have within that time period. So again, leave the book value completely out of it. It is irrelevant except for tax. It is actually what you have deposited into the account that matters only, and where your market value is. So again, forget the book value.